This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The yen slumping to a fresh 34-year low as the Bank of Japan hold rates but sees inflationary risks skewed to the upside. Tech shares surge after blowout Alphabet and Microsoft earnings. AI-fueled cloud demand driving that investor frenzy. Global bonds selling off with yields soaring. Sticky U.S. inflation eroding hopes for even a single Fed rate cut this year. Plus, the UAE makes further inroads into the AI sector. We speak exclusively to the managing director designate of newly merged firm Space42. It's just gone 8 a.m. across the Emirates. I'm Bonnie Quinn in Dubai, and it is shaping up to be a very different Friday session to the Thursday session. We are already seeing a nice bounce for U.S. futures, pointing to big gains at the open after declines of around about 0.5% for the S&P 500 and the Nasdaq 100 in the Thursday session. This, of course, after Alphabet and Microsoft blew away estimates and basically showed investors, yeah, we're spending quite a lot, but we are seeing returns. We are actually getting names from the likes of Alphabet saying their customers include Goldman Sachs, small businesses and so on. We also obviously had that US data, the GDP data, slowing and maybe not in an easy way for the Federal Reserve. And also we had personal consumption down from a year earlier, but we also see that the market is repricing for the Fed to perhaps only cut once this year and then only in December. So you see the two-year yield rising to almost 5% again, 4.9934. And then Brent crude holding on to those gains at 89.32 a barrel. We'll get to the yen in a moment because we are strengthening once more after the finance minister spoke. But I do want to show you this chart because we had super after-hours trading for Alphabet, rising as much as 17% in the after-hours. Microsoft up more than 6%. But in the previous session, this was what was really causing the impact. US GDP underwhelming, and then we still have that sticky inflation, PCE price growth higher than expected. Let's get back now to the yen slumping after the Bank of Japan held rates steady and maybe loosened its language a little bit on bond buying. We have Avril Hong in Singapore to tell us how assets are reacting. Avril. We'll get back to Avril in a moment. Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu joins us now. So, Stephen, the BOJ didn't threaten to tighten aggressively. It also gave itself some leeway on bond buying potentially. How should we interpret the totality of the decision?
I mean, it's obvious that it's probably not as hawkish as what market would have liked, because market was expecting some sort of explicit guidance about tapering QE or even QT, but that's not in the statement. So basically, BOJ said that they're going to continue to buy bonds at the pace of 6 trillion per yen. They didn't put that in, but they say they're going to keep doing what they said last time for March, which is the buying. So that's why there's no tapering this time. So that's why market was clearly disappointed. So you saw yen selling off against the dollar. Now we're talking about over 156.
And then we had some comments from the finance minister, Suzuki. He didn't seem too perturbed about yen weakness, and we've seen the yen now trade back in the 155 plus mark. How is this all playing out for the currency? It's a lot of volatility, right?
Yeah, to be honest, when we look at when the BOJ is likely to intervene, we look at two metrics. The first metric is clearly the level. From a level perspective, I'm sure the BOJ and MOF is watching because at 155, it's clearly higher than what we had over the last 2 years. But the second metric that would trigger intervention is actually the pace of the yen decline against the dollar. Now, from that angle, actually the yen drop was pretty gradual if you look at compared to last year or the year before. When the BOJ comes in and intervene, usually we are talking about over 1.6% weekly drop against the dollar, and also for consecutive weeks. But now, especially after the yen stabilization near end of March, early April, the drop actually slowed this year. So that's why from a drop rate of decline perspective, I think the BOJ can still wait a little bit longer, but it's not that long because the dollar is still so strong against the yen.
What happens to bonds from here, Stephen? You know, as you said, there might be a tiny bit of flexibility, but also it did mention the March purchases. So, you know, we might expect continued purchases around the 6 trillion yen mark.
Yeah, I mean, they will have to taper or QT eventually, just because the problem is that after all the QEs over the years, now the Bank of Japan owns over half of the JGB market. And as we know, there's no healthy developed market has that kind of share out there. So that's why eventually now the timing is ripe. They have inflation coming up. Growth is still okay. So now it's a time to actually sell or stop buying more JGBs. So going forward, And what's interesting today is we actually saw a much shorter statement. So that's probably the norm going forward. So statement's going to be shorter, and the market, we focus on like when they're going to put it that line of we're going to slow JGB purchase. So it's just a matter of time. We still think it's going to happen this year.
Stephen, thank you. That is Bloomberg Intelligence Chief Asia FX and Rate Strategist Stephen Chu. And as the market awaits the news conference in less than 90 minutes now, let's check in on how markets across Asia, in particular in Japan, are faring with Avril Hong in our Singapore studio. Avril.
Yeah, you touched with Stephen on the yen move. So let's take a closer look at what we're seeing on JGB futures. And it wasn't just about how we had U.S. Treasuries slumping, that sell-off overnight that put pressure on Japanese bonds. It was also markets in Japan, traders really bracing for the signals of the start of quantitative tightening. And we did not quite get that from that BOJ decision. And it said it's going to keep those bond purchases in line with what it decided in March, but it did drop a reference to 6 trillion yen of bond purchases. So this is something that Governor Ueda will have to clarify in his presser. We're seeing those bond futures, which initially spiked, coming a little off right now. But let's flip the board and take a look at what we're seeing among stocks. It was a fairly flat performance earlier on as we waited for what we heard from the BOJ as we got that decision that's perhaps not coming in hawkish. We're seeing the stocks in Japan extending gains, of course, across Asia. It is that tailwind coming through from the big tech names. Bonnie.
And we're going to stay with that now. Avril, thank you. That's Avril Hong in Singapore, because those big tech names, Microsoft and Alphabet in particular, soaring in late trading as first quarter earnings beat expectations on strong AI demand. Alphabet President Ruth Porat says the firm is ecstatic about the results.
We are very pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base.
Meanwhile, Microsoft CFO Amy Hood said they're focused on continuing to achieve double-digit growth for the next quarter.
In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24.
Robert Lee is a senior analyst for Bloomberg Intelligence and joins us now. So it seems like the messaging has changed, or at least investors are deciding that it's okay if these firms spend billions and billions on AI and CapEx if they see results from it, right, Robert?
Yes, I think so. But the key difference between the companies we heard report last night and Meta, which came a couple of days earlier, is Alphabet and Microsoft are much more broadly spread. So the rump of Microsoft's business is in the PC business, the software business. I mean, they were very solid results from Microsoft. If I was going to grade them, I'd give them a solid A grade. Whereas Alphabet, I think, is really in the A-star territory because their advertising business is really performing very strongly. It was the strongest quarter of sequential growth in 8 quarters. The margins came in substantially ahead. The cloud business came substantially ahead. And all that upside offset, the increase in CapEx that you referred to a moment ago. That is not what we saw with Meta. So no wonder the market took the Alphabet results so positively. And then I'm afraid on the downside, we've got Intel, which has failed the class again. And they've got, company-specific issues, perhaps, of their own making.
Yeah. Shares there in late trading down more than 9%. I do want to ask you about Microsoft, though, because it does seem like Copilot is defining the terrain. Almost 60% of Fortune 500 companies now signing up. That's
right. I mean, they're strong initial momentum on there, but don't forget to put things in context. It is early days. And again, a comment I've made before, these companies are spending tens of billions on CapEx. And whilst the monetization is beginning to come through, their AI businesses in aggregate are still loss-making. But things are beginning to move in the right direction for Alphabet and Microsoft. So, that's initial encouraging sign, but it's going to take many, many more quarters for them to get into break-even, I think, on that front.
All right. Robert Lee, thank you so much. Senior analyst for Bloomberg Intelligence there for us. And I want to bring you some breaking news now. Meituan is debuting service in Riyadh. Meituan, the Chinese app, obviously food and other deliveries. It's debuting its service in Riyadh. Global expansion coming quickly there. It had been eyeing the Middle East for quite some time, and it looks like it is now actually beginning that foray. Of course, it'll be in competition with some Middle Eastern companies that already do food deliveries, such as Careem, for example. But again, Meituan, which has done extraordinarily well in China, is expanding now beyond China. It'll debut in Saudi Arabia after, of course, already debuting in Hong Kong. The China market is slowing, so it's going to be another avenue of growth for Meituan. Still ahead, Space 42 is poised to become one of the world's most valuable publicly listed geospace companies. We're going to speak exclusively to Managing Director Designate Kareem Sabak about their business strategy. That's later in the hour. This is Bloomberg. Welcome back to Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Well, global bonds follow a sell-off in treasuries with yields rising to 2024 highs. This as evidence of sticky U.S. price pressures casts doubt on whether the Fed will cut rates at all this year. Let's bring in Saeed Abukarsh, ARC Capital Management Senior Executive Officer. Saeed, thank you so much for joining. So much has happened in the last 24 hours, but really yesterday's big news beyond the tech earnings was that we still have this sticky inflation and it's causing the bond market to reprice yet again. How many times, if at all, does the Fed get to cut this year?
Well, I think we're going to get some good guidance over the next few months, basically, in terms of what the Fed's intention is. Obviously, we began the year with a very bullish bond market outlook. A 2-year really took the hit there. But I think the main theme here is the Fed about to change their whole paradigm? Again, we mentioned this before in ARC, that basically the Fed needs proof. They need real solid proof before they actually begin to cut. And the story has been since the beginning of the year, well, you know, the Fed has to cut. That forward guidance, forward guidance, forward guidance, forward guidance. And the story now is shifted that, well, it isn't as clear-cut case of cutting, and actually, is there even a case of hiking? Well, I don't think we're even there yet, but I think what the main story is that maybe we should really pull back our expectations for a significant cut, perhaps symbolic cut, but this real story is that maybe we push the first cut into Q4 and actually begin to have a more quarterly cut as opposed to a consistent cut. I think that's the story is. Now, if we get inflation numbers or data that actually indicates inflation is actually might be picking up again, that might change the whole outlook and force us to a very different scenario for the Fed.
How did you read the GDP data? Because on the one hand, it did show slowing, which might have been welcome to the Fed, except that it was things like net imports that contributed to the lower GDP data, so maybe not as easy to interpret.
Well, the GDP data is one part of the equation. I think the real part of the equation here for the Fed is going to stick with the PCE, they're going to stick with the unemployment. That's the real key here for the Fed. The numbers GDP-wise, okay, we have a slowdown, we have a pickup. This is a secondary issue for the Fed. The real story for the Fed is, they want to give forward guidance to the equity market. Remember, the main driver here was we're going into an election year. And the point being is that they don't want to disappoint the markets in an election year. And that might actually be the main reason why we're seeing equities pull back a bit, that maybe the Fed in an election year may not be able to cut and deliver on their promise in January. So the Fed will look at GDP, they'll look at employment, they'll look at the PMIs, and that's where the mixing data is coming in. It's not a clear-cut case of, you know, we have inflation contained, we can move back and watch as we cut rates lower.
You've been focused on currencies quite a lot recently,
right,
and I'm curious as to your thoughts on the Bank of Japan. We've only had a few minutes really to react, but we did see the yen continue to weaken.
Well, again, this is a clear case where the market gets ahead of itself once again. We saw that in the beginning of 2024 when the market expected the Bank of Japan to actually move out of negative rates. Well, it did, but is it something to write home about? Not really. It isn't significant because we're talking about a bank who is basically not going to repeat the same mistake that they had done 2 decades ago. They're going to go very slow. And in an environment where basically inflation is still patchy, given the last 4 years or 3 years of post-COVID pickup, you know, we still have the supply lines disruptions. We still have unregressed data set from history. So I think what the market is looking for here is, well, the BOJ talks very clearly that the rates could be too high in terms of the dollar-yen, that they may come and intervene. But is this a situation where the Bank of Japan will intervene to actually come in and reverse a trend? Unlikely. We've seen it before in the 140 zone where the BOJ has come out and said this is too high. Well, it's about slowing down the pace. The BOJ is more concerned about the pace of the currency depreciation as opposed to the actual number. Now, we hit 165, 160, 155, that's not the issue. The issue is the pace. Is the pace fast enough now to talk about intervention? Not really, because we saw it happen earlier. We saw the market sell yen once again. And the main story again here is differentials. You have the BOJ at near zero, and you have the Fed now, actually, which is the treasuries are actually moving in a different direction. So the spread once again is widening. It isn't the case where the spread is contracting, or like January. It's a case where this case is very clear that this is the best carry trade out there right now.
We also have potential problems in China with its currency, right? How closely are you watching that?
Very closely. Main reason is because we entered the year again with the idea that China is a slowdown, would have one of the main levers for the PBOC would actually be the depreciation of their currency. That hasn't played out. What's happened is that you haven't lost money being long dollar China because of primarily the forwards, the carry that you obtain there. But it's not been a slam dunk trade. That's been very much of a sticky trade. Now, if we do see China actually move that lever, which is unlikely in the short term, because right now what we're seeing is China is trying to preserve the integrity of the currency, trying to provide a second alternative to the dollar or the euro in terms of the fixed income market, at least. I think that's really the one that we're watching for, and that if we do see the market capitulate, that could be a very clear indication that China is more worried about their economy than we thought before.
Saeed, what happens if the Fed can't cut soon, if it's December, maybe even if it goes into next year, and it's one of the last central banks to cut?
And this is the main question: does the ECB go first?
Yeah.
You know, we've seen other banks.
It's looking very
in.
likely now.
So
right?
if the ECB goes first, that really puts the dollar in an unprecedented position where actually they've seen the cycle move forward and they're still up there in terms of rates. I think we could see euro dollar really rally and down to maybe 103, 102, even parity is possible. But if we do see a situation where cuts are off the table completely, you know, this is not the situation where we see GDP pick up, we see unemployment sticky, and we see, well, you know what, that was a recession. That was it. It's over. And now we're going to a new growth stage. Well, in that situation, we can see dollar pick up quite considerably. Now, again, this will not be very comfortable for the Fed, given that we're going into election cycle, but it is, and it would require them to have a lot of forward guidance. So you will see Fed members come out and say, well, listen, maybe things aren't as deflationary as we thought before. Maybe this is going to be a longer state of inflation. Maybe we've moved to a new cycle. So the Fed's very good in giving us forward guidance, a forward indication of what their intention to be. So I don't expect to see a massive shift, but we will see a dribbling of Fed speak coming out, changing their views.
A dribbling of change. Saeed, thank you so much. Always great to speak with you, and thanks for coming in. That's Saeed Abukharsh, ARC Capital Management Senior Executive Officer. Coming up, BHP drops the most in 7 months after its offer to buy Anglo American. We discuss the impact of any potential buyout next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Reuters reporting Anglo American does not consider a proposed takeover offer from BHP attractive. BHP's bid would value Anglo at $39 billion. If successful, the deal would create the world's largest copper miner. For more on this whole thing now, let's bring in our commodities reporter Martin Ritchie and Bloomberg's Jennifer Zapasaja. So, Martin, analysts are saying the deal is targeting Anglo's copper assets. Explain why and what it says about the global copper market.
Yeah, that's right. BHP's shares are actually down today after they confirmed that they're making this offer worth $39 billion for Anglo. Look, I think everyone looks at this deal and thinks it's all about copper. Anglo has a sort of tangled spread of assets, from diamonds to potash used in fertilizers to iron ore, but it's copper that's very attractive for BHP because miners are expecting a big wave of demand in the coming decades. Now, the shares might be down. Investors may be a bit cautious about this deal. Firstly, because, as you said, it's been reported that Anglo is not really happy with the offer, but also because this is a very complex deal. As I said, a lot of different commodities, a lot of different jurisdictions. Exactly. They have to spin off assets beforehand. So perhaps investors thinking, BHP's taking on quite a challenge in making this big bid.
Yes. Well, and Jen, you're in Johannesburg, so how might this all affect South Africa's mines?
Yeah, Vonnie, I mean, Martin was just highlighting just how complex this company really is. And if we take a look at, in particular, the mining industry for South Africa is very important to this country. It's one of the biggest exports for this country. And in particular, South Africa accounts for almost half of Anglo's revenue. But of course, as we mentioned, BHP does not want the South African businesses potentially because of just how complicated they are. And so if this deal were to go through, it would require the demerger of South African listed companies, Anglo American Platinum, and also Kumba Iron Ore. But given just how many centuries, decades long mining and Anglo American has been here in this country, many people are concerned about what could this potentially mean for jobs. Anglo American has already had a pretty difficult year. They've had to restructure. They've cut some jobs here. And so the question is, what could this mean? What could these companies look like without its parent? And what could an Anglo American, the fourth biggest stock on the FTSE JSE, actually look like? So yes, as Martin noted, very complicated for South Africa.
And Jen, what has been the response from South Africa already?
Yeah, it's very interesting, Vonnie. I mean, as I mentioned, Anglo has a very long history here in this country. And so the reaction was very swift, and in particular from the government. And the important point to note here is that the state pension fund, South Africa State Pension Fund, or Public Investment Corp, is the main shareholder in Anglo. And so they, of course, will have a say in what actually happens. What we heard on Thursday after this news, they said the mining sector is a critical part of the South African economy, impacting a wide variety of stakeholders. Therefore, new opportunities that may arise in the sector may need to be taken into account. They also said that they're going to assess this. But interesting enough, Gwede Mantashe, yes, which is South Africa's minerals minister, we had him here just a few weeks ago. He said this is not a deal that he would approve.
Jen Zapazaja in Johannesburg and commodities reporter Martin Ritchie, thank you. Do stay with us. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The yen slumping to a fresh 34-year low as the Bank of Japan holds rates but sees inflationary risks skewed to the upside. Tech shares surge after blowout Alphabet and Microsoft earnings. AI-fueled cloud demand driving that investor frenzy. Global bonds selling off with yields soaring. Sticky U.S. inflation eroding hopes for even a single Fed rate cut this year, perhaps. Plus, the UAE makes further inroads into the AI sector. We speak exclusively to the managing director designate of newly merged firm Space42. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's have a look at the results of that tech-fueled after-hours rally yesterday. Well, it's looking like this for U.S. equity index futures. Nasdaq 100 futures pointing to a gain at the open of 1.2%. This was after Alphabet and Microsoft. Not Intel, though. Intel was down 9% after hours, so it is not across the board. It is mainly those companies that are showing that they have something to show for their AI capex spending. Brent crude holding on to gains, and I want to point to the two-year yield, which is very close to 5% again. This after the data yesterday. If we look at this chart, we'll see exactly why. We're seeing slowing growth in the United States, and perhaps not for the best of reasons. Personal spending slowing as well. But we are also seeing stickier PCE inflation, as you can see from this chart. The other story is that we are waiting for Governor Ueda to speak. We had the Bank of Japan decision, and that is impacting assets across Asia. So let's get to Avril Hong now in our Singapore studio for more on that. Avril.
Yeah, we got the Bank of Japan decision where it stood pat on rates. This was as expected, but it also, in its statement, came through very brief. It dropped a reference to 6 trillion yen of bond purchases, but it did say that it's going to keep the bond purchases in accordance with its March decision. And it makes you wonder whether this brevity this time around is causing confusion. For now, it looks like the market is not really reading this as a hawkish surprise from the BOJ. We're seeing the yen losing further ground against the greenback. It's popped above that 156 level, losing ground against the Aussie and the euro as well. Bonds in Japan still coming under pressure. As you alluded to there, Vonnie, we are keeping an eye on the Ueda press that flipped the board. And as the attention shifts to the words from the mouth of the BOJ governor, we are seeing the Japanese stocks perhaps breathing a sigh of relief and able to join in that bump up this end of the week trading session. That is thanks to that big tech tailwind, and we're seeing the Japanese equities extending some of the earlier gains in the session after we got that BOJ decision. Vonnie.
And that news conference coming in about an hour. Avril, thank you so much. Avril Hong in Singapore. Gulf nations using their petrodollar wealth to wield influence on the world stage and diversify their economies away from oil and gas. But the process also carries risks for the region. Ziad Daoud is Chief Emerging Markets Economist for Bloomberg Economics and joins us now. So Ziad, the GCC, it's wealthy. How is it deploying its wealth?
Well, it's very wealthy. It's got more than $5 trillion of assets abroad. It's very active in investments. We're seeing it investing in American tech companies, English football clubs, African mines, Egyptian real estate, you name it, Turkish bank deposits. So what is the purpose of these investments? And I think there are three main goals. The first one is to diversify income away from oil in case oil revenues drop in the future. The second purpose is to build soft power, the ability to influence through persuasion, through values, through culture. And that's why we're seeing investments in tourism, in sports, and even in rebranding in the case of Saudi Arabia. And the third thing is basically economic diplomacy, deploying the wealth to further political goals.
Yeah, you've been writing that the Gulf countries are turning hydrocarbons into geopolitical muscle. I mean, you can almost trace it exactly, right? How is the effort going?
Well, that's not something new, right? So the most famous example is probably the oil embargo of the 1970s, and that was using economic tools to further political goals. In the 1980s, the GCC bankrolled Iraq in its war against Iran. In the 1990s, it rewarded countries like Egypt, Morocco, and Pakistan for supporting Kuwait when Iraq invaded Kuwait. And that process has continued. So we're still seeing deployment of wealth in a number of countries in order to create, for example, political stability. The most recent example is the UAE investment in Egypt, which, yes, it did have a commercial dimension, but there's also a clearly political dimension that is interested in the stability of Egypt. And it's not just Egypt. We're seeing, deployment of aid to places like Pakistan, Jordan, and Bahrain and other places.
How can Gulf countries continue to maintain this pattern of spending and maybe even, make sure that decisions that each one makes ripple around the world?
Well, the key thing here is oil, because the source of all this wealth is oil. And as long as oil prices remain high, the GCC is able to accumulate surpluses and build up wealth and therefore invest and deploy this wealth to achieve their targets. The risk here is if oil prices start, falling and this deployment of aid starts drying up, it presents risk not only for the GCC, but it's also for the countries that are addicted to GCC support.
Yeah, exactly. And we are going to continue to talk about this in a moment. Ziad, thank you. Ziad Daoud is our Chief Emerging Markets Economist for Bloomberg Economics. So let's bring in Simon Williams now, Chief Economist for the CEMEA region at HSBC. We can talk a little bit more about this. So, Simon, we have seen diverging performances, particularly as it pertains to diversifying revenue from oil to non-oil sectors. How is that effort going? Has momentum slowed across the GCC?
I think it's uneven. There have been very substantial changes in some parts of the Gulf. I think generational changes in some parts of the Gulf. The shifts here in the UAE and also in Saudi Arabia, I think, are fundamentally changed the economic landscape. They've already lifted potential non-oil growth rates. I think that's why this cycle is different to cycles that have been before. Elsewhere in the region, the movement is less marked, and there I can already see some signs of the pickup in economic momentum that there was as oil prices recovered post-COVID. I can see signs of that momentum beginning to fade.
You're still constructive, though. Is it just that the time frame will be a little bit longer than originally thought?
No, I'm still constructive. On the GCC region as a whole, we've got non-oil growth running around 4.5% on average, on a weighted average basis across the Gulf. That's double the pace of global growth. I think that growth is broadly driven. There's consumption growth off the back of strong employment numbers and strong demographic growth. I think it's investment that's going to be the big driver for this year and into 2025 as well. And really, there's nowhere else in the world that's sufficiently confident there's access to funds of this kind of scale to be able to finance, to be able to consider a capital spending programme of this kind. I guess also that growth is still pretty well balanced. Inflation is low, fiscal position is strong, and the currency, because the dollar peg, well, that's robust too.
Well, exactly. What about the quality of the growth, though? We just heard Ziad talk about the various investments that some of the countries are making. Maybe not all are paying off in the way that the countries would like. Is the quality of the growth strong?
It depends how you judge it, but yes, I think certainly in the two biggest economies in the region, it is a non-oil growth driven story. I think it is increasingly going to be drawn along by the increase in capital spending that there is, and I do see this cycle as being supported by this broader structural reform programme. Look at the changes here in the UAE and the way in which the UAE positions itself in the global economy. Look at those enormous domestic economic changes in Saudi Arabia. This is a fundamentally different economic growth model to that which was there before.
How are we seeing those changes demographically? So are populations responding?
I think they are. And again, the demographics is one of the things that marks this region out. You know, there are other parts of the world which have strong demographic growth, have youthful populations, but none really that can offer that kind of demographic profile with the wealth that the GCC already commands, the openness to inflows of new people, to new expatriate workers bringing their skills and their capital alongside that domestically driven demographic expansion. Yeah, I think it works.
You mentioned capital. Are the capital markets strengthening? Are they as robust as they need to be for this growth to continue?
It's a work in progress. Some parts of the region clearly are ahead of others. Equity market development is gaining pace. The IPO programme that there's been over the last 2 or 3 years is part of that. And certainly I'm talking to many more international equity investors about the Gulf than I have been in the past. But debt market as well. You know, this region is now a key member of the emerging market indices. It does have access to global markets for funding at a time when other parts of the world are struggling. So, yeah, I think it's ongoing, but the gains there have been are substantial.
Yeah, well, clearly we're seeing huge amounts of effort being put into regulation here in the UAE. When it comes to Saudi, we're seeing a lot of effort being put into the debt capital markets and strengthening those and so on. What concerns you about the region?
There are headwinds. Of course, there are headwinds. I think part of it is what happens when you've had a growth story which has been so strong. Incremental growth can become a little harder to generate, hard to maintain momentum. Obviously, the geopolitics creates headwinds as well. Uncertainty brings hesitancy, and that inevitably reflects on the kind of spending choices that get made. Also, in a very strong dollar environment, the appreciation of the dollar driving Gulf currencies higher. That makes it easier to export non-oil goods and services on a price basis. And interest rates. I mean, interest rates are significantly higher than they would be if the Gulf ran its own monetary affairs. That means that monetary sense is tight, which means the reliance on fiscal support is greater than it would otherwise have been. My forecasts are running off oil at $80 a barrel. So quite a conservative number given where prices are today. And I think that does give the region the fiscal space to offset some of that monetary tightening that would otherwise be holding the growth story back.
Let's take one example. Let's take Saudi Arabia. How does it navigate relations with other countries? China and the US is really what I'm aiming at here. How does it keep both happy and also sort of warm relations with both?
Well, I think Saudi's prime focus is looking after its own interests, and I think what you are seeing is a much stronger assertion of a clear Saudi national identity. That's apparent in the political decisions that get made, but also increasingly in the economic choices as well. Saudi can be part of both camps, of both parts of that geopolitical landscape, and that's clearly key to its economic fortunes. What I do see increasingly, though, in the region as a whole, particularly in Saudi Arabia for those economic links, is a shift east for trade, for capital flows, and that's clearly got very strong government-to-government backing as well.
Absolutely. The Israel-Hamas war, is that impacting growth rates in the region or, decision-making in terms of aiding Egypt, for example? Will it have long-term impacts on the economies of the region?
There's a few different questions in there. In terms of near-term performance, I'm looking for we track sentiment as closely as we can. So far, sentiment has held together. Look how the capital markets have performed since October 7th. Clearly, an initial moment of shock, but then a recovery. I think in terms of the capacity that this region has to absorb those kinds of geopolitical uncertainties, with the balance sheet so strong, I think the risks to stability are low. Clearly, it has some impact on the kind of growth outlook, because we're in a very different geopolitical environment to the one we expected to be in on October 6th. And those uncertainties have some impact on the spending choices that get made. But I say so far, what I'm seeing is sentiment holding together the consumer sentiment that I see looks good. The conversations I have with governments and other policymakers around the region's awareness of the uncertainty, but also still a very strong commitment to those long-term development plans.
So broadly positive outlook, I would suggest. Simon, thank you so much for joining us today. Wonderful conversation there with Simon Williams, Chief Economist at HSBC for the CEMEA region. Coming up, an exclusive AI interview with new UAE firm Space 42. You don't want to miss it. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Let's turn to AI now, a sector that's become central to the UAE's plans for economic growth. Abu Dhabi-based firms Bayanat and Yasat have just merged to create geospatial analysis and satellites firm Space 42. It's a division of tech conglomerate G42, which is involved with some of the biggest US names in tech and AI, including Amazon and OpenAI. For more on this new venture, now joining us is Karim Sabag, Managing Director Designate of Space 42. So, Karim, this literally just got approved a few hours ago by both boards. Why the agglomeration? Why the merger?
Thank you for having me. The merger is predicated on three parameters. One, there will be an increasing relevance of use cases that intersect between satellite communication and geospatial analytics. Case in point is the DriftX event that is underway in Abu Dhabi, where we are witnessing a number of autonomous platforms, air, sea, and land, and where we're seeing satellite communication and geospatial analytics converging. Two is because the technologies in space are going to converge, and so operating them together makes more and more sense. And last but not least, to your point, is that artificial intelligence is going to be a foundational element of serving customers across the entire satellite spectrum.
What does the merger mean for the UAE's position in the global space race, let's say?
Well, first of all, it positioned the UAE as a spacefaring nation, in my mind. And certainly the merger is a reflection of, first, the UAE National Space Strategy 2030, and the National Strategy for Artificial Intelligence 2031. So in a sense, what we are doing is very consistent with the leadership vision as to what you want to do. And also, in a sense, a continuation of the partnerships that we at Space 42 will be pursuing with best-in-class technology partners in the world, whether it's in Europe or in the US. So very, very consistent with the trajectory of the nation.
Karim, a few words just on the financials. I presume you'll stay listed. What will the dividend policy be, for example? And might you be looking at, taking on more companies, making more acquisitions?
Our thought process is threefold here as to how we intend to use our capital. First, we will continue to invest in developing our existing business. In technology, you need to continue to adapt and evolve. Two, to your point, there is going to be a number of cases where there will be opportunity to add complementary capabilities, and a number of these conversations are underway. And equally important, and the third lever is to return money to the shareholders in the form of dividends. So in our mind, these three parameters go together. And at the end of the day, this is going to be a discussion between the management and the board. But certainly, that's the way we're thinking about the use of capital.
Can you give us any more color on those conversations, Karim? Are they local companies? Are they US? Are they China-based?
So certainly all our partners are based in Europe, to the case Airbus and Thales, and in the US, the likes of Boeing and SpaceX. And that's the trajectory that we will continue pursuing. In space, there are a handful of global champions, based on my experience over the past 2 decades. And these are some of the names with whom we're partnering on an ongoing basis.
Is there a relationship with the China space program still? There had been, and there was a memorandum of understanding signed, as I understand it, but perhaps that's not the case now. Maybe there was some US opposition?
In the case of YESAT and BINAT, the single-minded focus is on working with partners in Europe and the US. So in the case of BINAT, there was an announcement, if my memory serves me well, in 2023, where we teamed up with ICEYE, a Finnish firm, to deploy an advanced generation of geospatial spacecrafts. And in the case of YESAT, they've announced last year a number of programs. One of them is already underway, Thuraya 4, under the partnership with Airbus, and 2 other programs are under finalization with similar partners based in Europe and in the US. So that's pretty much the single-minded focus of how we approach this. We do not have working relationship with China or any comparable programs.
This merger creates a mammoth company. It's an implied market cap of more than 15 billion AED. I'm curious as to how it might compare with the Saudi plans. We learned at Davos that Saudi wanted to make a big investment in space along with other technologies.
Well, we're clear about our ambitions, and we always sort of approach our ventures in space with a mindset that no one has a monopoly in space. I think there is a lot of room in space for every nation to do formidable work. And space at the same time has a sovereignty dimension, so it matters for the UAE to make sure that it has strong capabilities in space for civilian and commercial applications. So we will look at our program in this manner, and certainly we look forward to team up with other programs in the region, the Saudi as a case in point.
What's the growth potential here, Karim?
Well, for us, there is no barriers to what you want to do. First, because you still have a very large segment in the world that remains unconnected. So our satellite communication capabilities can be brought to bear immediately. And when it comes to geospatial analytics, the field is truly exploding. You could have compounded annual growth rates anywhere between 40 and 70%, depending on which segments you are serving. And so what is fantastic about bringing these 2 businesses together is, on the one hand, you're bringing a very stable base with proven technologies, with a lot of legacy on the side of BINAT, satellite communication. And then you're merging this with a high growth business in geospatial analytics with BINAT. And you have the best of both worlds. And that's exactly how we're approaching it.
You know, it used to be the case that you'd get data and it would have to be sent back down to Earth in order to get analysed and parsed and so on. Now that can happen in orbit. Karim, tell us about the challenges and also the potential for this kind of computer power or orbital computer power.
You're absolutely right. What is absolutely essential is to be able to extrapolate, analyze, and interpret the data in the most efficient manner. And efficient is threefold. One, can you do this with the least sort of lag time, because you need to sort of be able to respond to certain requirements. If you're driving a car and the car needs to know exactly what it has to do in the next 50 centimeters, you can't have high latencies. So this is one case. Two, you need to be able to do this with the least cost. And so if you're going to send the data is going to be captured in space, sent back to Earth, and in Earth sent to some other point to be interpreted and analyzed and interpreted. That's not going to work. So cost optimization is going to matter. And last but not least, because of the richness of the use cases before us, there isn't going to be a single source of data that's going to be able to fulfill the requirement of a use case, whether it's in transport or tracking, what have you. And so the idea is, what is the most efficient way to fuse information from different sources, whether terrestrial or aerial or space, And so that's, I think, is going to bring the onus on us as technology operators.
Yes.
Deploy in space almost cognitive capabilities that can provide us with the solutions immediately.
Kareem, congratulations on the merger. Literally just a few hours old. That is Kareem Sawag, Managing Director Designate of Space 42. Plenty more still ahead right here on Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. Next on the agenda, Governor Ueda's news conference. That starts in just more than a half an hour. Let's take a look at the yen. It's trading above 156.20. This after the policy hold was pretty dovish. Few hawkish signals in the BOJ statement. Bond buying to remain at March levels, although there is perhaps a little bit of flexibility there. So that's coming up. You don't want to miss that. Then, of course, later in the day, we have the U.S. session opening. It looks like it's going to be a nice bounce to reverse those declines that we saw in the Thursday session post-GDP data and post-PCE data in particular. We had Alphabet and Microsoft beating substantially, and NASDAQ 100 futures show a bounce of 1.1% for that at the open. And then we have the two-year yield close to 5% again after those data will have confused the Fed potentially, or at least made its job maybe a little bit harder. Stay tuned into the European